Annuities have a reputation problem. Some of it's unfair, some of it's earned. If you've seen the YouTube ads, annuities are the worst thing you can buy, or shh, they're the secret retirement tool nobody tells you about. You've seen both extremes. Neither extreme is right. The truth, like everything, is somewhere in the middle. And the middle is harder to sell you on a 30-second ad. I'm Micah Brown with Legacy Financial Solutions in Petoskey, Michigan. I'm insurance licensed, which means I sell annuities, among other things. I have a bias here to disclose, and today I'm going to talk to you honestly about annuities. This episode is a conversation about annuities I want my own family to hear. The honest pros, the honest cons, who they fit, who they don't, and the questions to ask before you sign anything. Let's go. Disclosure time. I'm insurance licensed in Michigan. I sell annuities when they fit. I get paid to do so. That's a financial conflict of interest, and I'm naming it so you can weigh what I say accordingly. This is educational, not advice for your specific situation. Insurance and annuity guarantees are subject to the claims paying ability of the issuing carrier. Here's what I'm going to cover today. Why annuities are bad. What an annuity actually is. The 4 types of annuities you're going to encounter. The honest pros, the honest cons, who's a good fit for it, and who's not a good fit. And 7 questions to ask before signing your contract. Okay, so reason number 1 why annuities got a bad rap. They were sold poorly for decades, sometimes by people who didn't understand the product, and sometimes by people who did, but chose not to explain them to you, the client, which can be even worse. Some patterns kind of erupted out of this. These can be complex financial instruments, and they were sold to people who all they needed were simple income. That's not okay. Another reason why is annuities were sold inside of IRAs, which isn't necessarily a bad thing, but they were sold under the guise that you were getting tax deferral benefits. Great, but your IRA already gave you that. Doesn't make a lot of sense there. Can also have a long surrender period, which again is not necessarily a bad thing. But if you were someone who needed liquidity soon and disclose it to your advisor, that's going to be a problem. Another thing that happened was replacement transactions. Agents would come along and say, hey, we've got this new, better product. Let's put you into it. The only thing that benefited them was that they got another commission. Didn't do a whole lot for the client. So what happened because of this? Regulators started to push back. Disclosure got better, which is great. The suitability standards we now have are there for a reason, to protect you, the client. So what happened because of all of this? Really? Annuities got a really bad rap. A lot of households have a policy sitting somewhere in a cabinet. They may remember, they may not, but they wish they hadn't bought. Number 2, sometimes annuities can have high commissions. I said it. Not always the case, though. And what happens? It's not paid by you, the client, directly. They're built in the product's cost and surrender schedule. You wouldn't even know it. But guess what gets sold? Something with a higher commission and something with a lower commission. That's just distribution economics. You, the client, ultimately pays through reduced returns, through reduced caps, lower participation rates, or a longer surrender period. Not every annuity has high commissions. Some products are designed with lower commissions and lower costs. But high commissions cast a long shadow on our industry. Another unfair reason. Annuities get judged like investments. They're not investments. They're an insurance contract. They have a completely different job. That's to transfer the risk from you to the insurance carrier. Generally, that risk is longevity, i.e. running out of money. Sometimes market related, and sometimes both. So, what happens when you compare your annuity to the stock market over any time frame, say last 10, 20, 30 years? Generally, the stock market's going to be better. They're not trying to solve the same thing. It's not a fair comparison. They really have different jobs. You wouldn't compare your homeowner's policy to stock market returns either. That's not what your homeowner's policy is there to do. It's to be there when your house gets burned down, not to grow. It's an apples to umbrellas comparison. It sounds sophisticated, but it's really not. So, when you have bad sales practices and high commissions, that's where the unfair reputation comes in. Throw on that some agents were touting that these annuity contracts can get really good returns, sometimes even beat in the stock market. People have a very valid reason to feel this way. The honest version is going to be somewhere in the middle. So next we're going to talk about what an annuity actually is. It's a contract between you and the insurance company. You're going to give the carrier some money, sometimes all at once, sometimes it's going to be a series of payments, sometimes both. Carriers are going to promise to pay back based upon the contract terms. A couple of differences that we're going to talk about in the next section, but sometimes payments are going to start immediately, sometimes later. Sometimes they're going to last for only a set period, 10, 20 years, sometimes for the rest of your life. That's the entire structure. Money in, defined payments out on your contract terms. There are going to be some variations that we're going to talk about, sometimes regarding timing, when your payments are going to start, the duration, how long they're going to go for, how they grow, whether they're going to be indexed or fixed, any riders that come along with them. Sometimes they have them, sometimes they don't. Sometimes they're built in, sometimes there's a fee. There can be a lot of features across most types. Carriers carry all of the longevity risk in annuity contracts. So guess what that means? If you're the person that lives to 102, the carrier is going to pay you till you're 102. Really, that longevity piece is the core value of an annuity, and that you have guaranteed income coming in every month, regardless of what happens in the market. Everything else just gets engineered around that product. There's 4 types of annuities. There's dozens of names for them. They all come from a marketing background, though. Most are going to fit into 4 pretty much basic types. First, you have your single premium immediate annuity, or a SPIA. There's a lot of acronyms in our world. So what that is you give the annuity contract a lump sum. The carrier is going to start paying you a defined amount, generally monthly, and usually within a year. That's going to happen for a set period, which you get to elect when you issue the annuity. You can do it for your life, for a fixed period, or for the life of you and your spouse. This is the simplest annuity structure out there, with the simplest trade-off. Give up access to a big lump sum of money for a defined benefit of income for a set period of time, or for the rest of your life. The income that's going to come into your bank account every month is going to happen no matter what happens to the market. Who is this a good fit for? Retirees who want to convert a portion of your portfolio into a guaranteed paycheck and not have to worry about it. What a lot of my clients do, they like to do this to make sure that they have their needs met. Not wants, just needs. And big caveat here, that they're not going to need that portion of the portfolio for anything liquid. A SPIA, or single premium immediate annuity, is not good for anyone that's close to retirement who needs flexibility towards their balance. Or if you haven't defined your income needs yet, which can be a tricky thing to figure out. Next up, we're going to talk about a deferred income annuity. It's the same thing as what we just talked about, but your payments are going to start years later. So you're going to buy today, payments are going to start later. You could be 50, 55, get one of these, and then your payments might not start for 10, 15, 20 years. These are called longevity insurance. It's designed for late retirement when you're not sure exactly what's going to happen. Maybe you need it for increased healthcare costs. Hard to tell. So, who's this a good fit for? Pre-retirees with enough resources to cover your early retirement costs from other accounts, whatever they may be, and want to ensure that their later retirement years, when other resources may have been depleted, they still have a check coming in. Who is it not a good fit for? Anyone close to retirement who needs income soon, or who don't have early years covered by other sources. Next, we're going to talk about a fixed annuity or a MYGA, multi-year guaranteed annuity. Here's what's going to happen on this one. You hand over the carrier a lump sum. The carrier is going to give you credits that are contractually defined for a certain period of time, typically 3 to 7 years. At the end of each period, you can renew, withdraw, annuitize, or do a 1035 exchange into another product. It's kind of like a CD in the big sense, in some ways, but it's insurance backed, and you get beneficial tax treatment. You're not paying tax every time that CD renews. Who is this a good fit for? Pre-retirees that are looking for a defined rate, tax-deferred component as part of their broader plan. And as always with an annuity, you don't need anything liquid out of this during the term of the annuity. Who is it not a good fit for? Anyone close to retirement who needs full liquidity during that time frame, or who needs growth potential beyond a defined rate of the contract. Type number 4, a fixed indexed annuity or a FIA. This one, to be honest, is the most common of the four and gets sold the most aggressively, right or wrong. How's this one work? Well, the carrier is going to give you interest credits on a market index, generally S&P 500. Other carriers are diversifying into other ones though lately. It's going to have a cap, which is the most you can earn, and a floor, which means the money is not going to go down. You can have participation rates or spreads, which limits how much you can earn in a good year, but you're also going to be capped in bad years by the floor. In most FIA structures, your principal is protected from market loss with your upside capped. Some of these contracts include guaranteed income riders. They do come at an additional cost though. That'll give you defined lifetime income regardless of how the index performs. Who are these a fit for? People who are close to retirement who want some upside without market loss. And generally they're paired with an income rider for retirement income. Who are they not a good fit for? Anyone close to retirement who wants full market upside. A FIA will cap it. Or, and I'll be honest here, people that don't understand the mechanics of what's going on behind these with the caps, participation rates, and spreads. They can be complex, and the contract terms vary widely. And lastly here, we're going to just touch on variable annuities, the fifth type. These involve actual investments that are based into sub-accounts that are market-based. You do need a securities license. I do not have a securities license. I do not sell on them. I do not advise on them. They have their own pros, cons, and reputation issues. They are outside of my lane and scope and outside of this video, and we're not talking about them. Now, after getting through the types of annuities, we're going to talk about the pros of annuities. Pro number 1, the longevity risk transfer. When you start an annuity, basically what you're doing with handing over that lump sum of money, the carrier is going to assume all of the longevity risk, which means you cannot outlive your money. The carrier assumes everything related to the longevity risk. For retirees worried about what happens if I live to 95, 100, 105, who knows where modern medicine is going to take us? There's no investment-based strategy that really solves that. An annuity does. Pro number 2 is the predictability. Your income is defined by the contract, not by market performance like your other accounts. Your advisor's other tactical decisions that's going on, any quarterly rebalancing, anything else that goes on. It's what the contract says. It's going to hit your account every month. What a lot of my clients use these for are just for your day-to-day expenses, your needs, not your wants, that have to be paid every month. So this way, they know that what they need to have paid is met. No exceptions. Number 3, tax deferral on growth and non-qualified accounts, of course. Annuities that are in a traditional just cash, not a tax-deferred account like an IRA, are going to get the same tax benefits, i.e. you're not paying tax on the gains until you go to withdraw the funds from the contract, whether that's a full surrender or you're going to start annuitizing them. So if it's inside an IRA, you already have that tax deferral. This benefit doesn't really add anything. That's one of the issues with selling annuities inside of IRAs that we talked about earlier in the video. That's a reason for the annuity, so you don't need to double dip on that twice. Pro number 4, sequence risk protection for your income. This is huge for the clients that I work with, especially that are within 5 years of retirement or 5 years post-retirement. And this is tied back to our second episode. With the floor, your income is guaranteed to come every month. You don't have to sell your portfolio when things are not going well in the market, which has happened and probably will happen again. Just don't know when. So what that means is you don't have to sell in a down market and worry about taking your losses. Next, we're going to talk about honest cons. Con number 1, they're illiquid. Annuities lock up money for a certain period of time. If you need to get your money out, there's going to be surrender charges. Now, there can be some free withdrawal periods in annuities, so you might be able to get some of the money, but not all of the money. That's going to have different surrender schedules that are different based upon each annuity contract. Some are short and some are long. Just depends on what you bought. So the most common regret that we see with this is that people bought one, maybe bought too long of a surrender period, and really wish they hadn't because they couldn't get their money out. Con number 2, these are complex financial instruments. There can be simpler products, sure, like a SPIA, somewhat basic like a MYGA. They're not too complex. Basically, with the SPIA, you give the insurance company your money in one lump sum. They're going to start sending you a check every month. With the MYGA, they give you a predetermined interest rate over the term of that annuity. Then you move into your more sophisticated products. You have FIAs with riders, variable annuities, again, which we're not touching on in this because I'm not licensed to do so. Those can be very complex. And complexity is where consumers get hurt with the FIAs. So this is what I tell my clients. If you can't explain to me back in your own words what the contract does, you are not ready to sign it. And I won't let them. Con number 3, you have opportunity cost on the locked up portion of the money that's in there. So any money that you get to the annuity company is no longer tied to market upside. So if the market does well over the contract period, really you lost out on some growth there. The trade-off, you got a guarantee, and that's worth understanding before signing, not after. Con number 4, sales pressure and bad fits. At worst, the salesperson will pressure the buyer towards a complex product or replacing it that only benefit the seller more than the buyer. Some markets are worse than others. Some agents are better than others. And knowing the 7 questions that we're going to touch on later before signing your annuity contract make all the difference. So, who are annuities a fit for and who are they not? So annuities are a fit when these are true. The income that needs to be funded predictably and with no pension covering it, that's when an annuity makes sense. You have a long enough time horizon that the surrender period isn't a constraint anymore. You have other assets outside of the annuity for any liquid expenses and discretionary spending. You understand the contract, what it pays, when it pays, any conditions that it has, the surrender schedule, and any riders. And not putting all your assets into the contract. Most well-structured plans use annuities for a portion, not the whole thing. Who they're not a fit for? Well, if you need your full liquidity on your principal, they're not a good fit for you. If you could be uncertain about your money and locking it up for a certain number of years, that could create a problem later. If you're being pitched a complex contract and you don't understand it, and it's not getting any clearer the more meetings you have, it's just not a fit. You haven't defined what your income gap is between what your needs are and what your wants are and where that money's coming from, and will that annuity solve that problem? And if someone's telling you to put all your money or most of your money into a single annuity, that's almost always the wrong answer. Next, we're going to talk about the 7 questions before you sign your annuity contract. You have to be able to answer these, and if you can't, don't do it. Number 1, what exactly does this contract pay? When does it pay? And under what conditions? Number 2, what's the surrender schedule? And what's the cost if I need the money in years 1 through 5 or longer depending on the surrender schedule? What's a carrier's financial strength rating and from which rating agencies? What are the fees and costs, if any, both explicit and implicit over the life of the contract? What problem in my plan does this contract solve? And is there a simpler product that solves the same problem? What's the commission structure, and how does this contract compare to others paying lower commissions for similar coverage? And what happens if I die in year 3, in year 15? Are my beneficiaries protected, and how? If the person selling you the contract can't answer all 7 clearly and in writing, you don't have enough information to sign. It's better to deal with uncomfortable math now than confronting assumptions until it's too late. So let's recap here. Annuities are insurance contracts that transfer the longevity risk and provide contractual income. They have honest pros: longevity protection, predictability, tax deferral, sequence risk protection, and probate avoidance. They have honest cons though. They're illiquid, complex, they do have an opportunity cost, and a sales environment that's done some real damage to consumer trust. They fit some pre-retirees well, They don't fit others. The fit depends on your gap, your liquidity, your time horizon, and the specific product. The 7 questions are the filter. Comment the word annuity below or DM it to me on Instagram, and I'll send you the annuity decision filter. The 7 questions plus the worksheet I use to evaluate any annuity contract before recommending it. No charge here. Again, this is education only, not advice for your specific situation. Insurance services offered in Michigan only. Insurance and annuity guarantees subject to the claims paying ability of the issuing carrier. That's the last episode in the pre-retiree series. The full set covers paycheck conversion, sequence risk, Medicare, the 5-year runway, and now annuities. Links are in the description below. Thanks for watching.